Well, good evening. Welcome to our Mississippi State Alumni Association Homebuyer Workshop. My name is Jason Maida. Great to be with all of you this evening. Thank you so much for taking time out of your busy schedules this week, which I'm sure it is a busy week because it's a short week. But we're really appreciative that you decided to spend a little bit of time with us this evening. This is our homebuyer class that we provide 4 times a year for the Alumni Association. So in partnership with them, we're presenting you just some tools and some resources around homeownership. This is essentially a class to help you on that journey towards homeownership. And so we're glad that you got a chance to spend this time with us. This is a very interactive session that we provide. So what we always encourage our classes to do is to, have interaction with us through questions that you might have as we go through different content tonight. So you can use either the chat feature in Zoom or the Q&A. I'll be monitoring both windows as well as my colleague Ken will be helping me out as well, kind of watching what questions are coming in. Now, we always like to start off our classes by just getting a chance to share a little bit where our class is from or maybe where you're considering buying. So if you get a second just to put in the chat where you're thinking about purchasing, whether it's in the state of Mississippi or anywhere beyond, feel free to drop that in the chat. That always kind of helps me because as we're going through our classes, we talk a little bit about market data. And so we'll spend some time talking about the Mississippi housing market. But if you're looking, of course, in any other type of markets, we'll be able to help give you some kind of a glimpse into what those look like. So if you feel free to put that in the chat if you'd like to. Now, American Pacific Mortgage, just so you can learn a little bit more about us. So we're the leading, our team is one of the leading provider of first-time buyer programs across the country. Our company is the 9th largest lender in the country. And our team in particular focuses on home buyer education to help support our future buyers. So we can give you the tools and resources to help you make a really big financial decision like this. And we are a nationwide lender, like I mentioned earlier. So depending on what state you're looking to purchase in, we'll be able to help service your needs in whatever market you're considering. All right. For those of you who got a chance to use the chat already, so I'm already standing corrected. Most of us aren't in the state of Mississippi, so it looks like we have a few looking outside of the state. So thank you for that. So we have Indiana and Tennessee, and if those are the rest of you guys in class, if you feel comfortable doing that, that's all good. But we will spend some time talking a little bit about the housing market in just a bit. Well, here's our discussion points for tonight. We're going to spend some time looking at that housing market, also spend some time talking about interest rates. So that's a topic of conversation with a lot of our clients that I've been working with throughout the week because there's a highly anticipated Federal Reserve meeting on the 17th of this month. So we're just, 14 days away. So we're kind of trying to see what the next move is by the Federal Reserve of if they're going to cut interest rates. So we'll talk a little bit about that tonight. We're also going to talk about renting versus buying. So if we're considering staying on that same course of renting today, how does that compare versus what it looks like if I decide to buy? So we're going to show you some of the benefits of buying that we want to take into consideration when we're considering home ownership. We'll also spend some time looking at credit. How do we look at some areas of opportunity in our credit profile to help increase that credit score? Talk about loan programs that are available to you. Some of the maybe terminology that you've heard in the past or in your searches, we're going to kind of tie that all together for you. We're also going to look at savings for homeownership. That tends to be one of the bigger challenges for most of our first-time homebuyers. We're going to walk you through some of the documents we generally validate to see how much we have in assets, but also put together a savings plan to help build enough resources for you to help you in homeownership, and also spend some time looking at first-time homebuyer programs. So there are some wonderful resources and tools available to you as eligible first-time buyers. We'll spend some time diving into those. Also talk about the home buying process. So essentially, after we leave today's class, where do I go from here? How do I kind of maybe execute on my plan of home ownership? So we're going to walk you through some next steps tonight. Our run time for tonight's class will take us right up about to the top of the hour. We are recording tonight's class, so if you get a chance to maybe look back at our class, you can hop on our YouTube channel. You'll see that up there tomorrow morning. We also share back all of our slides from our presentation, so that'll also be sent to those that have signed up for tonight's class. We'll have all those resources and tools available for you as well. All right, so let's go ahead and dive in, and let's kind of start our conversation by talking a little bit about, does buying make sense for me? So for most of us in today's class, this is going to be our largest purchase we decide to make whenever that time comes. And so obviously, you're taking time out of a busy Wednesday night schedule to learn a little bit more about what this all looks like. So clearly you guys understand the importance of it. But I think we need to kind of look a little bit deeper into, does it make sense for me when we consider, affordability challenges in the housing market? So for some of us, getting into today's market may be a little bit challenging because of just the cost of housing, but for others, it might be super opportunistic. When we look at stability in our housing budget, that's a really big attribute of home ownership because now I can have a fixed payment that I'm making on my mortgage, and I don't have to worry about my landlord increasing the rent every year that I renew my lease. There's also the ability to see growth in your wealth, essentially in home ownership, because as my home goes up in value, that's called appreciation. As I continue to pay down the principal balance of my mortgage, that difference between those two numbers is called home equity. For most of us across the country, that's our number one asset. And it does have the opportunity to really create generational wealth for so many families across the country. And there is tax benefits that are still available potentially for home buyers or homeowners, I should say. Potential tax deductibility of interest, as well as some of the tax benefits that come along with doing any type of energy upgrades to your house. So I always encourage clients, when you think about home ownership, think up a little bit beyond just the comparison of paying X amount of dollars to rent versus what it's going to look like in home ownership, because there are so many great benefits that come along with home ownership. To kind of frame that up a little bit better for you, I thought I would walk you guys through one of our calculators or our tools that are available to you. That's called our rent versus buying calculator. In fact, we have a video that we're going to put on our social channels tomorrow that kind of highlights a little bit more about how we think about home ownership and how we can integrate all the benefits of tax benefits and equity appreciation back into our plan of home ownership. So I thought I would just kind of walk you guys through this calculator. Again, I'm sure we're going to share back all these slides with you tomorrow so you can run through this calculation yourself. But this calculator kind of works like this. So you first would enter an expected sales price of your home. We're going to talk a little bit about minimum down payments in just a bit, but you would put a minimum down payment in there, which today is 3% on a conventional loan for first-time buyers. That would essentially mean that you're going to finance 97% of the purchase price. We have the average interest rate. We have the term of my loan. So we have a 30-year fixed term. And then we have the assumption that we're going to buy our home sometime soon. This is actually a little bit dated. We can kind of change this to today's date. So we can assume that we buy in the third of the month. And then we have mortgage insurance. We're going to talk more about mortgage insurance in just a bit. But ultimately, mortgage insurance comes into play when I put less than 20% down to purchase my home. So we're going to add that into our calculation. We also want to factor in homeowners insurance costs. Those are going to vary based upon what part of the country I'm considering home ownership. We have tax rates of my home. So this calculation factors in 1.2% of the purchase price as my tax rate. And then for those of us that are thinking about buying in some communities that include HOA or homeowners association dues, you could add that into your calculation as well. And then the other thing we want to think about is, what does that look like comparing that to rent, right? So we have an assumption here that someone's paying $1,500 in rent, that their rent insurance costs are about 1.2% of the rental amount, and that their rent will go up 2% on an annualized basis. So essentially, when we look at our comparison here, there's a few ways that we kind of look at it. One is, when do I break even on buying versus renting? So when do I get to a place where it makes sense for me to buy versus renting? Well, the break even point in this scenario would be 3 years. So essentially, I will come out ahead of my investments in home ownership versus renting at the 3-year mark. Now, as I own longer, that number starts to grow for us. So like, let's say, for example, if I look at over the course of the next 10 years, my opportunity of home ownership versus continuing to rent, and of course paying someone else's mortgage, that's because that's generally what you're doing in a rental situation, is about a $76,000 buy gain opportunity by owning a home over the course of 10 years versus renting for 10 years. Now, how do we get to that conclusion? Well, it comes with the equity appreciation being a huge chunk of that part of the equation. Now we're looking at appreciation rates in our scenario here that are right around 3%. So we're not doing anything wildly unexpected, but that's a big part of it. Also, the potential tax savings that we have as homeowners. So, that is really where the opportunity lies for us in homeownership. Now, at the same time, we want to make sure that we create a reasonable budget for clients. And that's part of our consultative process we do with clients, is just to figure out, what's an affordable monthly payment amount for us in home ownership, and is now the right time for me to consider home ownership? So I would encourage you guys, when you have some time, work on that calculator yourself. I think that'll be a great exercise to kind of get the thought process going about what home ownership can look like for you. Now, those that are considering entering the market, they're obviously looking really closely at what's the housing market doing, right? So many of you in today's class have already probably been on websites like Zillow or Redfin to kind of like see what's out there in neighborhoods that you like in your respective markets. Well, let's look at the Mississippi housing market in general, just collectively. Some of the southern states are seeing a little bit of a slowdown in the housing market. We are seeing inventory starting to stack up. You can see in the state of Mississippi right now, we have 45 days average days on market. Some states we're seeing high as 50 to 60 days median days on market. So what's happening, we're getting this growing amount of supply, but not necessarily enough buyers willing to act. And so you are seeing a situation where more sellers are far more negotiable than they have been 2 years ago. You're seeing sellers that are willing to give concessions, not only on price, but concessions on credits towards buyers' closing costs, which can also make things a much more affordable for our clients deciding to purchase. Today in the market across the country, there's 4 states that have the highest level of inventory in the market. Those markets include Georgia, Florida, Texas, and then Colorado. I don't know if anybody's considering looking in those markets, but those are the markets that really have the biggest supply right now. And we're seeing a lot of negotiations going on in those markets. Now, if you look at the Mississippi housing market, we see this kind of downward trend, right? So when you have these higher level of inventory days on market, and then you have maybe buyers not willing to pay a certain price, guess what happens? Obviously, we're going to see prices start to drop. Now, I think it's as we're considering home ownership, I think what's going to move the needle for most buyers re-entering the market is what's happening with interest rates. And I think we're starting to see some encouraging signs of interest rates starting to go down a bit. We're seeing a bit of a decrease. There's a highly anticipated Federal Reserve meeting on September 17th. So we're just 2 weeks away, as I opened up in our discussion today, that everybody's watching really carefully. I think the last numbers I got in was that we have about an 86% chance of the Federal Reserve cutting rates at that meeting, which would be obviously a welcome sign for us. But I think as future buyers, let's just really understand what that means for us. So, of course, the borrowing costs go down. We'll see some of that automatically start to spill into mortgage rates right away. But it is a direct one-to-one ratio cut in borrowing cost for your personal loans, credit cards, auto financing, things like that. But it will have a natural spillover effect into mortgage rates. Usually, mortgage rates dropping will be a precursor to what the Federal Reserve decides to do 2 weeks from now. So we're already starting to see some signs of improved interest rate environment. We're starting to see that average 30-year fixed rate come down a bit. You can look at some of our data here, even going into the end of last week. We're starting to see that mortgage rate drop a little bit. It has been a very bumpy road this year in interest rates. The on again, off again with tariffs. Are they happening? Are they not happening? So there's the overall kind of geopolitical environment putting pressure on the economy. So we're really watching that really carefully. But as we get the signal from the Federal Reserve that they will cut rates, that will definitely be a welcome sign for mortgage interest rates. There are some speculators indicating they think the Federal Reserve may cut rates another 2 times. So that would mean 3 rate cuts before the end of the year. That would be huge for us. I don't know if we're quite there that yet to really make that assumption, but certainly some good things on the horizon. I think as future home buyers, you need to understand that as interest rates go lower, when we look at the competitive climate in most states across the country, that will start to pick up. Now, I know we do have some seasonality in markets in some of our colder weather states that we're going to see a slowdown just because of the weather. But ultimately, those interest rates going lower, which they are going to go lower, just more of a not an if, it's more of a when, will bring more buyers to market, without question. And so we're obviously watching really carefully what's happening in the markets. Now, the Federal Reserve is watching what's going on with inflation right now. The mandate for the Federal Reserve is a 2% inflation level. We're still running at 2.4, 2.6, somewhere in that area. But as inflation comes down, then you'll see the Federal Reserve probably act on the rate cuts, which obviously that's what we're kind of speculating for this month in 2 weeks. So that's kind of where we're at today. Now, over the last 20 years, you can see the cycle of interest rates. So we look back 20 years, interest rates were just about the same. Of course, home prices were a fraction of what they are today. But, I think it's important to understand as consumers that as we go through economic changes up and down in the market, that does influence interest rates. You can see kind of, what we faced here with the housing crisis of 2008, 2009. This other gray bar represents the pandemic. Of course, that ensued with interest rates hitting the all-time low of 2.5%. I like to kind of share this with our class because I think it's important to put things in perspective that we're probably not going to reach 2.5% rates ever again. And hopefully we don't, because that means something seriously has happened globally. The average interest rate on a historical average is in the high four to low five. So that's normally where we'll see rates land. But there always will be these peaks and valleys in interest rates. Interest rates change by the minute during the open financial trading day. So it's really kind of a ebbs and flows throughout, the business cycle. All right, so that I think gives you kind of an insight of interest rates, where we're at today, where we think we're going. But I think ultimately, as you're looking at your product options as a buyer, it's really kind of important to understand that there's various characteristics that go into the interest rate. Things like your credit score and your eligibility for a product, the type of program that you're going to use, how much you decide to finance, what does it look like in terms of my down payment. If I'm going to put the minimum down of 3% versus a buyer that's putting 20%, those interest rates are going to look a little bit different. The cost that I'm going to pay for my interest rate, if I'm going to pay money out of pocket to bring down my interest rate, we call that buying down my interest rate with discount points. Generally speaking, one discount point is the equivalent of 1% of my loan amount, which will bring down my interest rate about 0.25%. And usually when I shorten the term of my loan, so traditionally we look at 30-year fixed mortgages, but if I decide to shrink my loan down to, say, a 15-year fixed loan, of course, that payment's higher, but it generally will come with a lower rate opportunity. Now, as we get a chance to meet with our clients and develop their home buying plan, we're going to figure out what the right design work looks like for you with home ownership. In fact, I had a call with a client earlier today, and we're kind of talking through budgets and looking at what the interest rate options look like in today's market and how much they can afford to put down. We're going to kind of package that all together to make sure you have a comprehensive plan. We'll talk more about that a little bit later in tonight's discussion. Now, as we kind of move along in our conversation tonight, let's talk a little bit about credit. Credit's probably one of the biggest areas of opportunity that we can kind of go after in our consultations to help our clients basically improve their borrowing costs. Now, I know many of you in class have visibility to different credit monitoring tools, and we'll talk more about that in our discussion tonight. But ultimately, every product that's offered by a lender has a minimum credit score. And you can see those score or products represented here on the left-hand side of the screen. Now, as we think about credit scores, there are 3 different agencies that report out those scores. And I guess I assume you guys are all familiar with those. That's Equifax, TransUnion, and Experian. They all give a different reporting of the score because they have different risk models. So the way it looks like from the lending standpoint, we're always going to look at the middle score of all 3 agencies' reported scores. So for example, if my highest score is 760, let's say my middle score is 740, and my lowest score is 720, we're going to use the 740 score as the middle score as the baseline score. Now, that is for an individual borrower. If I have a partner that's going to join me, and let's say my partner scores are slightly lower, maybe they're 720, 700, and 680, we're going to take the lowest middle score between both borrowers. So that would be 700 that we would use to evaluate the financing options. And that's important to understand because that can influence the product that you get offered as a buyer. That could affect the interest rate, the cost of mortgage insurance. All of those things are super important when we think about the design work for your home financing. So we always look at the lowest middle score of all 3 scores. Now, if you have any type of past events on your credit report, let's say a delinquent credit card payment or maybe an account that was over limit, when we have events like that, it's going to affect our credit score in the most recent 12 to 24 months from the date of the event. Now, the further I get away from the date of the event, the more kind of organic improvement I'm going to see in my credit score. So for example, let's say I had a late payment in October of 2024 on my credit card. Now that's currently inside of 12 months. Now, as I get beyond that 12 months, so let's say we're at November of 25, we're beyond 12 months. I probably had a little bit of an uptick in my credit score as I move past at least 2 years from the date of that last event. Then I'm going to see that score improvement even more. Now, late payments will stay on your report for 7 years, and this matrix kind of highlights that. So it'll appear on your credit report for 7 years, but the impact to your scores in the most recent 12 to 24 months from the date of the event. Now, if you want to learn a little bit more about what your own credit report looks like today, we'd always encourage you to sign up for some of the free credit resources that are out there for you. There are credit monitoring tools like Credit Karma. All the 3 agencies offer various credit reporting tools. we would always encourage you to at least have a look at your credit report every 6 to 12 months just to make sure there's no inaccuracies there. Now, if you've had any past challenges on your credit report, this is a matrix that shows you how long they'll stay on your credit report. But as we just kind of mentioned, the impact to the scores in the most recent 12 to 24 months. All right, let's take a look at the modeling for mortgage. Now, there are three different score models to the credit agency's reporting. There is a credit card model, which by the way is used in most of your monitoring tools that you see in Credit Karma or some of the other, resources. The banking institutions will offer you a free credit report. There's auto financing model, and then there's the mortgage model. And so, of course, if you're going to apply for home financing, guess what we're going to use? It's, of course, it's going to be the mortgage model. So let me just walk you through this profile of the model, and then hopefully you'll see as you look at your own credit report, there's an area of opportunity to help improve your score. So the first section is going to be length of credit. That's going to be essentially how long have I had my credit file open. So the more mature my accounts are, better my credit score is going to be. So, if I have credit for the last 6 months, as opposed to someone that has credit for the last 6 years, that person with a 6 year history, assuming payment history looks identical, they will probably have a higher credit score. So that's 15% of the weighting. 20% is going to be how much new credit am I trying to open? So am I trying to open up new accounts? Do I have what we call as hard inquiries on my credit? Hard inquiries will impact your score. Now, there are rules in place that allow you to shop for financing for both auto financing and mortgage financing. You have a 30-day window of time to shop around with those lenders as much as you want, and it's the equivalent of one credit inquiry hit to your score. Now, our process in determining financing for our clients looks a little bit different because we actually only do a soft credit score check for our clients. And the reason why we choose to do that is because as you work with first-time buyers, the buying cycle can be as short as 2 to 3 weeks. It can be as long as 2 to 3 years. And so we don't want to necessarily impact your score with a hard inquiry. So we only start with that soft inquiry. Next component is, and this is probably the biggest area of opportunity for most of our clients, it's how much do I owe on revolving debt, also known as credit utilization. So we're looking at credit limits versus credit balances. So for example, if I have $10,000 in limits available to me, but I currently have charged up $8,000 of those limits, right now I'm at 80% utilization of credit. Now, what we would encourage our clients to do if we saw that is let's try to figure out a way to get to 50% utilization, because that'll give us a little bit of an uptick in our score. Once we've reached that level of credit balances, our next step would be let's get to 30% or $3,000. And then the optimal level, which you see out of clients that have 800 plus credit scores, is 1,000 or less in that example. Now, here's the tip to kind of manage credit card debt. If you take a look at your credit card statement, there's two dates. There's a credit card statement date. There's also a due date. The credit card statement date is really important because that's the date that they're going to report out all your account information to the three agencies. So my tip for you tonight in class is try to pay down those accounts before the end of the billing cycle date or credit statement date. Because if you do that, you're going to get ahead of the reporting to the agencies. So if I took those balances of $8,000 and I shrunk them down to $3,000 before the end of the billing cycle date, what I'm going to do is going to lower my utilization of credit, have much more availability in credit. And then when it reports out to the agencies, I'm going to get a much higher credit score that'll appear for me, especially as I'm getting prepared for maybe buying a home, right? I want to try to optimize my credit score. Last section is payment history. That's pretty simple. That's how have I paid my bills, right? So if I've had any late payments, we mentioned earlier, especially in the most recent 12 to 24 months, that has the impact to the score. But if I have some challenges with payment history, they get rated as 30-day lates, 60-day lates, and then 90+ day delinquencies. All right. So we really want it. This is going to be the biggest area of impact next to credit utilization. All right. So that gives you kind of a glimpse into how we look at things from the mortgage score perspective. Now, as we know, student loans will report to the credit agencies. And so for those of us in class that do have student loans that are either in active repayment or not, I want to kind of walk you through how we view that from the lending perspective. So if you're in active repayment, let's say you have an income-based repayment program, and let's say you just have $75,000 in student loan debt and you're making an active payment of $250 per month. Now, we can use that $250 payment right away to qualify you in your mortgage financing, but it has to be an active repayment. So it can't be an IBR payment that was put in place 2 years ago and now you've been on forbearance since that. It has to be an active repayment schedule. Okay, so if you're in that situation or whatever type of payment plan, as long as you're actively paying, that's the amount we can use for qualifying. Now, if you're currently on forbearance, and a lot of our clients are still on forbearance that have maybe federal student debt, not so much private, but more on the federal side. If you're in forbearance or if you're in deferment because maybe you're going back to school, then if you're looking to apply for home financing, here's how we would apply the qualifying formula. So if you're looking at an FHA loan, we take 0.5% of the outstanding balances. For a conventional loan, it's 1% of the balances as the monthly payment. So that FHA payment would be $375 we would apply. For a conventional loan, it would be $750. All right. Now, some of our clients are in public forgiveness programs where, because they're working for public agencies, they'll have forgiveness of debt at some point in time. Even though that, and that's usually about a 10-year span of time, even though that eventually will be forgiven, we do have to count the debt today if we're looking to purchase a home in today's market. All right. So that gives you kind of a look at student loans. Now, the reason why we have to kind of examine students' loans a little bit closer, because obviously one is you're going to have that debt as a monthly payment. We want to make sure that it fits into your qualifying, but also each loan program that we offer has guidelines that evaluates how student loans are viewed. So in this segment of our class, I want to kind of dive a little bit deeper into loan programs and give you kind of a high level look at these, because you've probably heard about these in the past, but I just want to make sure you have a better understanding of that. So we're going to start with the conventional loan. That's a Fannie Mae and Freddie Mac loan. So you might have heard that terminology. Came up a lot back in the housing crisis of 2008. You're hearing more talk about privatizing Fannie Mae and Freddie Mac, and we'll see kind of how that goes. But ultimately, that offers the conventional home product for first-time buyers. It's a minimum down payment of 3% for a minimum credit score of 620. And then the maximum loan amount for that product gets set every year based upon cost of living changes. We call that conforming loan limit, which is 806,500. That changes each year, like I said, by the cost of living enhancements or changes. We'll probably have that number right around October or November. So that spans across the entire country. Next loan is an FHA loan. That is a government insured loan, minimum down payment of 3.5%. And you can see the minimum credit score on screen. Now, the difference with the conforming loan on conventional and FHA is that maximum loan amount will change based upon what county you decide to purchase in. Now, I want to tie together both the FHA and this USDA product because these happen to be both government insured loans. USDA stands for the United States Department of Agriculture. Because these are government insured loans, we did see some changes with the underwriting guideline requirements about 3 or 4 months ago, which means this is that to access those government insured products, you do have to be a permanent resident in the United States. So unfortunately, they've made some changes where if I'm a non-permanent resident, I would not have access to those programs today. However, if I am a non-permanent resident, I can still get access to the conventional home loan. That's still an offering that's available to us. But unfortunately, there was changes with residency status for both these products. Now, the USDA product can be popular in some of our markets like Mississippi or other states that have more rural areas that are available. Essentially, what this product does is it provides 0% down payment options for those that want to purchase in these USDA considered rural areas. That's the big benefit there. But the loan amount does change by the location. So essentially, there's two qualifiers that are really important. One, it's about the location of the property, but it's also about the household income. And there's limits based upon the location of that respective property. We have the jumbo loan up here. That's going to be more for clients that maybe need to purchase with a little bit more buying power that stretches beyond a conventional loan. But it does come with it higher down payment amounts, higher credit score requirements. And then finally, for our veterans that have eligibility for the VA home loan, the VA product has a 0 down payment option. There really is not a cap on loan amount. There is a minimum credit score requirement, but ultimately the VA product just allows a lot more flexibility for the veteran to have an entry point to home ownership. As you'll see later on in our class, the VA product will also complement with some of the first-time buyer programs. So usually these core 4 programs have some type of assistance options available to them, depending on what state you're looking to purchase in. All right, now, so when we take a look a little bit closer at loan programs, we got to look at what the minimum down payment looks like because every loan program does have minimum down payment requirements, But there's also something inside of loan programs called mortgage insurance that goes in effect when I put less than 20% down to purchase my home. So we like to kind of dive a little bit deeper in that with our classes. I'm going to explain to you both conventional mortgage insurance as well as FHA mortgage insurance. So conventional mortgage insurance is PMI, which is private mortgage insurance, and essentially insures the lender against default by the buyer. So if something was to happen to me, I had an economic hardship, the lender would be insured against the default by that buyer. Now, mortgage insurance on a conventional loan is based upon three important factors. It's based upon down payment, what my credit score is, and how much I finance. So the more I put down, the higher my credit score is, the lesser cost I'm going to pay from a mortgage insurance perspective. And one of the benefits of conventional mortgage insurance, it does have a cancellation option. So once I reach 2 years in my home and I have 20 to 22% equity, I can apply to have the mortgage insurance canceled. All right. Here's an example of conventional mortgage insurance. You can see our loan amount here. We assume a 740 credit score and someone that's putting 3% down. So with that level of amount financed, we're probably looking at about $92 a month. So what I always encourage our classes, when you're looking at calculators on Redfin or Zillow, you're going to get kind of a skewed look at what that payment looks like. We always encourage you to look at our calculators on our website because it's more calibrated to what actuals look like. So really the mortgage insurance is not as penalizing on a conventional loan as you might think. Now on the FHA side of it, it's a little bit different because there are two forms of mortgage insurance. There's MIP, which is mortgage insurance premium, and it does the same effect as PMI, which essentially protects the lender against default. But there's two forms of it. There's upfront mortgage insurance, which is 1.75% of my loan amount. And there's another monthly mortgage insurance of 0.55%. So those get both tacked on to the FHA loan. Now, the only way to cancel FHA mortgage insurance is you essentially have to refinance out. And the way we're looking at FHA as a product is it really is kind of a stepping stone or building block for our clients to get access to home ownership. But as they improve, maybe from a credit perspective, or maybe they have more equity in their home, we really want to look to try to refinance into more of a conventional home loan product. FHA is going to have a lot more leniency when it comes to late payments or minimum credit score requirements, maybe some of the asset requirements. It'll be a little bit more flexible to help support entry to home ownership for our buyers. Now, here's what an example of FHA MIP looks like. So if we took that same amount finance, we have to add on the upfront mortgage insurance of $5,250, and then we have the monthly mortgage insurance of $137.50. So, the cost structure is a little bit more on FHA, but from an underwriting perspective, we are going to see a little bit more flexibility in the overall eligibility for a client. All right. Okay, we just got a question that came in. I'm going to take that, and then we're going to talk a little bit about employment and income for home ownership. So in a hypothetical, is an FHA loan worth it if I plan to put down 20% anyways? Are there any other advantages other than late payments for FHA? So if you're going to put 20% down and assuming you meet the minimum credit score requirements for a conventional loan, we definitely would want to go with a conventional route because on an FHA loan, whether I put 20% down or I put the minimum of 3.5% down, we are going to have mortgage insurance. And so to my point earlier about FHA loans is it really is going to be a lot more flexible for clients that maybe have had some past challenges. So assuming, all things being equal, you meet the minimum credit score requirements and you have the 20% down, we would really encourage you to look at the conventional product. That certainly we can help you through as part of our one-on-one meeting for you. All right, thank you for that. So let's talk a little bit about employment and income for homeownership. So we get a lot of questions around eligible sources of income or, time on job and stuff like that. So let's spend some time talking through that. I did want to pass along to our class just some of the acceptable documents that we'll generally ask for in the home buying process. So if you're thinking about building your own personal home buying plan with us, I want to kind of pass along what we generally will ask for. Now let's talk a little bit about employment situations and what works in financing. So we do have to analyze the last 2 years of employment history when it comes to qualifying for financing. But one of the misconceptions in the marketplace is that I have to have 2 years on my job. So not the case. So I have to verify a 2-year work history or education. So if I just graduated from Mississippi State last fall and I'm really new to my job, I just started January 1, I can take my undergrad work in a hypothetical with Mississippi State and then my time on the job to make up that 2-year requirement. Okay, so I'm just verifying 2-year history. Now, in cases where I'm self-employed and I've started a new business, I do have to show 2 years of tax filing in order to count that income for qualifying. So that's where it looks a little different. Now, if I have a job that's in a variable compensation position, so let's say I have a base salary of $50,000, but I also get bonuses of $5,000 per year. If we want to count the bonus income in addition to my salary, then we have to show that I've been on that job for 2 years, because in underwriting of the income, we're going to take that bonus income because it's variable and average it over 2 years. All right. And then another thing that comes up in questions with clients is, maybe I'm on the job right now, and let's say I've been on my job for 5 years, but I'm thinking about making a move, and I have a prospective job offer letter, and I think I want to take it, but I really want to purchase a home right now. So even though we're in negotiations to secure a new job, we can still potentially use that offer letter to qualify you on your mortgage. So many people think they have to go on that job, start it before they can purchase their home. Not necessarily the case. As long as we have an executed offer letter, we can potentially use that to qualify you for your mortgage. All right. And then last thing I want to touch on is just other sources of income. So for example, if I have a spouse or a partner that is contributing to my household, but they don't plan on being on the application, then we won't be able to include that income unless we decide to add them to the application. One other thing I forgot to touch on really quick is just some clients will have multiple jobs. That's where the 2-year requirement comes in as well. So if we want to show 2 sources of income, let's say I'm working 30 hours at one job, 20 hours at another. If I want to count both sources, then in that scenario, I have to show that I've been on both jobs for 2 years. Same thing, similar rule would apply for someone that's driving for Uber or Lyft on the side. So maybe I have a 40-hour work week job, but I also drive for Uber and Lyft on the side. In that case, I would also show that I've been on the jobs for 2 years simultaneously. All right. So hopefully that's kind of helpful for you. We get a lot of questions from our classes about that. So I just always like to kind of cover that topic. Now, we're also going to look at what income looks like for you in your application, but we also compare that to what your outgoing expenses look like. We call that debt to income ratio. So I want to walk you guys through the calculation of how we view that. We're going to look at today's debts that we have. So things like credit cards, personal loans, car loans, and we're also going to factor in your projected housing expense. So if we look at a projected housing expense, that would include the principal and interest of my loan, property taxes, homeowners insurance, private mortgage insurance if I'm going to put less than 20% down, if I'm buying a condominium or maybe a townhouse, potentially HOA fees. So we're going to look at those expenses and we're going to compare that to your pre-tax income. So we gave you a kind of example on screen here. So we have in this scenario, someone that's going to buy a house and is going to spend $2,500 a month. They have $500 in current expenses. And then we look at that versus their pre-tax income. So we have $3,000 in expenses versus $8,500 in income. So in that scenario, the debt to income ratio is 35.3%. So that essentially tells me that 35.3% of that client's income is consumed by expenses. Now, we would say excellent in rating that would be 33 to 36%. That's kind of the sweet spot, if you will. But guidelines in lending can allow us to go to 45, even 50%. Now, those are conversations we're going to have with our clients to make sure the budget is comfortable and we design stuff for them, because ultimately we're really focusing on affordability in home ownership. The debt to income ratio just kind of gives us a guideline in qualifying. All right. Well, we're kind of rounding the corner in tonight's class. So we got a few more topics to cover. We're going to talk a little bit about down payment, and then we're going to talk about the workflow of buying a house. So let's kind of spend some time talking a little bit about down payment and savings for home ownership. So that can be one of the bigger challenges for some of our clients as they kind of work towards home ownership. You heard a little bit more about the minimum down payments for home ownership. Now, we not only have that expense to save for, but we also have closing costs and prepaid items that are part of our home buying out-of-pocket expenses. So if we have a 3% down payment on a conventional loan, for example, then we have the closing costs. Well, we want to bake in about 2 to 3% of the purchase price as our estimated expenses for closing costs. So that's kind of the goal line, if you will, when it comes to what we got to save for. Now, we can validate those sources of assets through various documentation places like obviously checking and savings accounts. Cash is not allowed in home financing. That's unfortunately not acceptable. Any accounts that we are going to use and introduce for home financing, the money has to be at least seasoned for 60 days. All right. You can use 401ks, 403bs, brokerage accounts. We always encourage our clients talk to your tax or financial advisor before you access those assets. And then gift funds can also be used in home purchasing. Now, those gift funds do not have a seasoning requirement. We just have to paper trail the use of those funds coming into your home purchase scenario. So as I mentioned, savings for homeownership can be a real big challenge for many of our clients. So I always like to share in our classes a really simple approach to savings that you can start on today. Especially we're at the first of the month, basically. We're only 2 days or 3 days into September. This is a great way to kickstart savings for you towards homeownership. So after we meet with clients, we kind of develop a budgeting goal, right? So we understand exactly, what does our monthly budget look like for homeownership? So if we were to say, put together a home buying plan for ourselves, and let's say our projected mortgage payment is going to be about $3,000 a month, right? But today I'm spending $1,500 a month in rent. Now, I know I can afford $3,000 a month based upon my income and my current debt load, but I just lack the savings of homeownership to really kind of buy today. What I would encourage our client to do is let's start saving like I'm actually making that $3,000 mortgage payment today. So on the first of the month, I'm paying my landlord the $1,500 for my rent, but I create the habit of taking an additional $1,500 and I make the automatic transfer into my savings account. So it's almost like I'm making that $3,000 mortgage payment. And then over time, I create that discipline or that habit of making that $3,000 payment, $1,500 to my landlord, $1,500 to my savings. Over the next 6 months, now I've accrued $9,000. Over a year, I have $18,000. That's a great way of kind of adjusting myself into home ownership. So it's not such a sticker shock, but I also am also growing my savings account over time. Okay, so really easy approach to that. Encourage you to put that in play if that's something you think is within reason for you. Now, there also are first-time homebuyer programs that can help you as well. So we, as a nationwide lender, have access to first-time buyer programs in every market that we serve. In the state of Mississippi, there are specific first-time buyer programs through the MHC program. There's $6,000 to $10,000 available in down payment assistance. What this is, it's a special zero interest rate loan that's available to you to help reduce down your total out of pocket. If you are a teacher, usually K through 12, there are incentives for teachers. There's also what we call a mortgage credit certificate, which is a really cool option for you, which essentially gives you a tax credit, usually up to 15% of the amount of the interest that you pay on your mortgage on an annualized basis. And there's other options if you're buying in more of a targeted area, so more maybe an economic challenged area, you can have opportunities to get additional resources as well too. Now, I know our class is in varying markets. So, for those of you that are outside of Mississippi, there are first-time buyer programs available to you in your respective markets. So usually most states have what they call as an HFA or a housing finance agency that supports low to moderate income households and homeownership. If you'd like to learn a little bit more in your respective markets, please let me know after tonight's class and I'll get you the information that you need for that. We do have nationally branded programs within APM. We call that the Pathway program. That is only on an FHA program, but it does provide 3.5% to 5% in additional funds, which when you think about it, could cover your minimum down payment for the home purchase, as well as some additional funds that could help support you towards closing costs. All right. So that's what it looks like as we kind of build a, kind of a design or a plan for home ownership. Now, I want to kind of share with our class, where do we go from here, right? So we've got a chance to listen to our content over the last, 30 to 45 minutes. Where do we go from here after tonight's class? Well, we would love to get connected with you for your free consultation to really kind of help you understand your options in home ownership, whether it's using assistance programs, figuring out a budget, maybe identifying some areas of opportunity and credit. But that's what we do as part of a 30-minute virtual session with you. Now, if you're ready to go for home ownership, then we get you pre-approved so you can really start actively shopping in today's market. You don't have to act on that right away. We have some clients that come out of a consultation and are not looking to buy for a couple years. That's totally fine. We just want to provide you a roadmap to home ownership. Now, this is kind of what we accomplish in our pre-approval consultation. The pre-approval is good for 60 days, but it kind of gives you your baseline for eligibility. So when you are ready to take those next steps, which would be step 2 in house hunting, you can do so confidently. Usually most of your searches will start online, looking on some of the various sites, and eventually transition to more in-person. We would encourage you to connect with a realtor that can help support you in your home search. When you select a realtor, they should be experts in the market. They should have a good sphere of influence that can, get you connected with properties that come online that fit your budget. But, if you need connections with a local preferred realtor that we can introduce you to, we're more than happy to do that. As you move through the house hunting phase, generally that's the longest cycle time of the entire process. So as we think about these 6 different milestones, step 2 is probably the longest one, because I might want to be in a certain neighborhood. I'm looking for a certain property. Maybe there's not a lot of choices on the market right now. So it could take, 2 to 3 months. Some clients, it honestly takes 2 to 3 years. But, obviously we'll be here to support you as you're looking at different scenarios. Now, once you identify the property that you want to go for and pursue in an offer, your realtor will help write up that offer. That offer will get presented to the seller. If they accept the offer, then we move to step 3, which is called entering escrow. So what that means is we have a ratified contract with a seller agreeing to terms that you've presented to them. Now, the day we get notified that that has happened, you've agreed to terms, you're going to get a call from me saying, congratulations, you did it. You have an accepted offer. Let's talk a little bit about next steps, and let's schedule you for your next virtual follow-up session. In that session, what we do is we go through all the final details of your financing, things like the interest rate and the out-of-pocket expense. We kind of fine-tune the program that you're going to do. And you're going to start to now see disclosures being delivered to you electronically that highlight all the things that we reviewed in our conversation earlier. Now, as you have an accepted offer, you're going to start seeing some action items coming over to you. Now, your email is going to start to go a little bit crazy because you're going to get a lot of requests from various parties that are involved in the transaction. You will be required to make what we call an earnest money deposit, which generally is 1 to 2% of the purchase price. That kind of holds true in most parts of the country, but it just varies based upon the contract terms that you agree to. Now, in most contracts, there's a thing called a contingency period, which essentially allows you to do your investigative work on the house, get the inspections done on the home, get your loan approved, and of course, get the appraisal done on the house to ensure that the house is worth what you're buying it for. And my role in these contingencies will be to handle both the appraisal and the loan in the process. So essentially what a contingency does is it protects your deposit, that if something just doesn't check all the boxes for you, it allows you to have an exit to the contract and not have your deposit impacted or be lost due to it just not being the right fit for you. All right. So as we move to the next milestone, that's more of the administrative functions of the processing of the loan. Now, from step 3 until step 6, that usually in most parts of the country is a 30-day process. So we call that the closing time period. It can be shorter than that. It can be also sometimes longer than that. Just depends on what your agreements look like with the seller. Now, step 4 is going to be the administrative task of the loan. That's going to be things like verifying employment, making sure your loan program is structured properly, looking at the assets you're going to use for your out-of-pocket expense. And we have a note here about rate locks. So we're going to be watching strategically the market about locking in the rate. So a lot of our clients, for example, that are going under contract this week, we're trying to wait a little bit longer to see if we can get a little bit more clarity on the Fed's cutting rates on September 17th, because that should spill into interest rates going low in the mortgage side. So those are ways that we're going to strategically work through the market once you're under contract with the seller, because we really want to time the market as best possible to get you the lowest rate available. All right, so that's step 4. Step 5 is going to be the loan approval phase. Now, that is part of your contingency where you're going to have your loan approved in a certain amount of time, but it generally is done in the first 10 to 14 days of the contract period. Now, with that loan approval, that the underwriter basically has essentially reviewed all of your income, assets, your credit, make sure everything matches to the loan program that you're applying for. That approval gets issued, and then our team will reach out to you for any follow-up documents as part of that approval. Now, once we get to step 5, you're going to get some final disclosures in the process. That initially is going to be a closing disclosure, which gives you a 3-day cooling off period before we get to the very final stage. Now, throughout this process in home buying, you're going to be getting electronic disclosures sent to you. Usually there's your initial disclosures that go out to you within 3 days of the accepted offer, another disclosure once you lock in your interest rate, and then the final closing disclosure within 3 days of the closing time period. And then the final phase is the closing of the loan. So that is one of the in-person activities that you do. You will have to meet with either attorney's office or a title or escrow team to sign final loan documents. That day, you also will deliver your final funds for closing. And as part of being your lender in the process, we're going to wire in the final funds for the home financing you've selected. So once all that money gets reconciled by the team, then they're going to record documents with the local county recorder's office. They usually record a deed called a grant deed to transfer ownership to you, as well as the deed, which is the security instrument for your loan, which tells you, what loan you're taking out against the property. That All those recording confirmations will come into the title and escrow team. Once we get word of that, then you are becoming the official owner of the home. So basically, once that confirmation is done, we get to say, hey, congratulations, you did it. You're now a new homeowner. And we get a chance to call you and congratulate you and say, hey, you did it. This is a huge, huge accomplishment. It's a massive financial milestone for our clients. And we hope you get a chance to experience that at some point. And we'd love to obviously be your partner on that journey as well. We've had clients come through the Alumni Association that we've supported through APM on their journey towards homeownership, and we hope you guys are the next ones. Well, if you're thinking about moving towards homeownership, I want to kind of give you some of the steps, the next steps that are involved for you, and we call it our get started information. So if you'd like to kind of learn a little bit more about what your options could look like for homeownership, I wanted to kind of provide you these 3 steps. And it's pretty simple. It includes an online application. You will upload documents after you've done that. The application portal will prompt you for that. And then you'll just use our scheduling system, which you can see here, to schedule either a virtual call or a by phone call. We encourage you to do the virtual call because then we can kind of strategize and have more of a comprehensive session for you. But that is a free service we provide to our clients. Just a reminder, we only do a soft credit check, so you don't have to worry about your score being impacted. Now, if you have some questions about maybe specific programs, or maybe you want to run a scenario by me after tonight's class, feel free to schedule an introductory call. That gives us an opportunity just to connect over the phone and just kind of go through any specific scenario that you'd like to kind of run by us, or just maybe a follow-up question from tonight's class. Just want to pass along kind of the content that you'll see in that free consultation we do for you. Things like budgeting, where we want to buy. We'll talk and dive deeper into assistance programs and credit analysis. Just ultimately kind of do a lot of things that we've discussed in tonight's class. We'll do them in more of a customized session for you. Want to pass along some of our technology. We really embrace technology, whether it's AI or some of our mobile tools. Our mobile can allow you to start the process right there. You can follow the course of your loan, as well as use some of the calculator functions in the mobile tool. Really great option for you as another resource. That doesn't replace the human side of our business. We really want to make sure we stay connected with you as we do this journey together, whether that's via text, call, or email. We're always available for our clients because we understand this is a major decision for you financially. As I'm wrapping up in our discussion, just wanted to remind you that part of our Mississippi State alumni partnership includes a discount for you. So your closing costs are discounted by $750. Not only do we have access to these free classes 4 times a year for you, but you also get the discount program as well as too. If you've enjoyed tonight's content, we'd encourage you to share this with your friends, family, some of your colleagues that might enjoy this class. We also have other partnerships spread out across the country that can help support those that you think might be in need of understanding a little bit more about homeownership. And this is all my contact information. So if you do have questions after tonight's class, I am going to open it up for questions again, just to make sure we didn't miss anything. But this is all my contact information there. Again, you can book an appointment with me if that's easier. And finally, we love what our community says about us and how they trust us in the largest purchase they're going to make. A lot of our experiences are shared on Google and Yelp, and we see a lot of it on Reddit. We're really proud of how we support our clients in homeownership. We understand, as a leader in homebuyer education, we want to make sure you're totally prepared to take on this huge financial responsibility. It obviously starts here with these classes. We get you prepared, and then we help you start that journey towards owning your own home. All right. So that's what we have for you in tonight's class. I hope you enjoyed what you've heard. I'm going to go ahead and open it up for questions. I know I got maybe 1 or 2 questions earlier. I think I've gotten those, but for those of you that are still with us, any questions that I can help answer for you? And you can use obviously the chat or the Q&A function within Zoom, whatever's easier for you. See if I'm gonna give it a minute in case everybody's feverishly typing away here. So, okay, I think we might be good. I will say, for those of you that feel like you're financially fit or want to understand if you're financially fit, now is a great time to really understand your options. I do feel like, this housing market is going to start to change quite a bit. We're already seeing significant changes in many parts of the country where it is flipping to more of a buyer's market. We haven't seen that in quite a few years. And so I think if you are giving some consideration around home ownership, we'd love to kind of really help you understand that, because I think there is some opportunities that are ahead for us as future first-time buyers. All right. All right. Well, thank you so much for spending a Wednesday night with us. Look forward to getting a chance to connect with you all soon. Have a great night. We'll see you soon.